Episode 57. In 1957, a gallon of gas cost just 30 cents. George Washington became the first president of the US at age 57, and in 1957, Lester B. Pearson won the Nobel Peace Prize for coming up with a peaceful solution to the Suez Canal crisis. Beyond MD, episode 57, here we go! Hey everyone, thank you so much for joining me again on Beyond MD. Let me ask you a question. What is interesting, complicated, misunderstood, and polarizing? That, my friends, is permanent life insurance, which is going to be the focus of today's episode and the next 3 episodes as well. It's a 4-part series. So this is a financial literacy podcast, and I take a lot of pride in covering a wide range of topics. And let's face it, insurance is a core part of financial literacy. Now, it's taken me more than 2 years to wrap my head around some of the topics related to permanent life insurance. So it took me quite some time to feel comfortable with my own knowledge base to come out with an episode. And it also took me quite some time to find somebody who I thought would come onto the show and discuss this topic in a thorough and balanced manner. Now, I know a few camps of people out there, and some people don't want to approach permanent life insurance with a 10-foot pole. Other people, however, swear that this is the holy grail. I believe in neither approach. I believe in investigating, I believe in deep learning, and I believe in learning using the right information, which is why I place a lot of emphasis in finding the right people to come on to Beyond MD to discuss these topics. So it is my goal through this series of episodes to give the listeners a roadmap on permanent life insurance, something that you can use to further your own learning. It is my hope that these episodes will help equip you with the right information to ask the right questions when you are approached about permanent life insurance. And let me tell you, you will at some point in your career be approached about these products. And it is my hope that these episodes become a go-to resource for people when they want to learn about permanent life insurance. Now, I want to make a few things clear. I do not own a policy myself, and I do not get any kickbacks when permanent life policies are purchased. So the 4-part series will be broken down as follows. Episode 1, which is today, we will be talking about the basics. So what is permanent life insurance? How does permanent life insurance affect the capital dividend account inside our professional corporation? What are the different types of insurance and definitions? So you will all have heard of things like whole life insurance. That is a type of permanent life insurance. So we'll be talking about participating and non-participating whole life and universal life policies. We will be talking about the core components of these policies, the death benefit and the cash surrender value, how to fund these policies, how they can be structured, and answering the key question of can a term life policy be converted to permanent life? Now, episode 2 is going to be an absolute beast where we will be focusing predominantly on participating whole life insurance because this is the most complicated. We'll be talking about how these funds invest their money, what the costs are behind these investments. We'll be talking about actuarial assumptions, how much we can actually tease from this, how dividend scales work, how dividend smoothing works, what expected returns will be. We'll talk about blocks inside these policies, illustrations, and key differences between the different types of permanent life insurance policies in a bit more detail. Honestly, guys, some of the information in episode 2 absolutely blew my mind. Episode 3 will focus on how we can use these policies. So looking at how the death benefit gets paid out, the corporate insurance retirement plan, infinite banking, which often makes me gag a little bit, and then the immediate financing arrangement. And then we will wrap it up in episode 4, talking about who is the ideal candidate for permanent life insurance. Now, understand that this is obviously an individual decision, and you will hear answers to this question sprinkled throughout the episodes, but I wanted to leave this towards the end because I really want people to understand what these policies are about. And remember, everything in life comes with pros and cons, but a deep understanding is absolutely critical. We will also be touching on how much commission agents generate when they sell these policies. I think this is critical, and I think it has to be disclosed. And we'll also be talking about things like what happens if you have to cancel a policy. So I will try to release 1 episode every single day so we can get some momentum with our learning. And now you guys know that I put a lot of effort into selecting the right people to come onto the podcast, which is why I'm really happy to have Jeff Bernstein on the show today. So Jeff Bernstein is the owner and managing partner of Seligman Insurance, which is in its 61st year of serving its professional client families, businesses, and community. As a third-generation insurance-focused estate planner, Jeff views himself as an educator, and guide to his clients and their professional advisors about insurance-based financial planning strategies. His approach is to blend high emotional intelligence with deep analytical proficiency. In addition to his diverse background before coming into the financial services space, Jeff holds the Chartered Life Underwriter designation, CLU, which is a very reputable designation. And he is also designated as a Master Financial Advisor in Philanthropy and helps charitably minded families achieve a bigger difference with their donations, maximizing impact and doing so tax efficiently. So as you guys will see in the interview, Jeff is extremely intelligent, very, very well spoken. It's a delight to have him on the show. You'll notice that some of my questions are quite direct, especially when it comes to how to use permanent life insurance policies and the sales pitch that we often get. And I'm not trying to be critical of the industry, guys. Trust me, what I'm trying to do here is investigate and get to the bottom of questions where I don't feel like I was getting clear enough answers leading up to this point. So very grateful to have Jeff on the show. So that's enough with the intro. Let's get on with the interview. Jeff, first of all, welcome to my podcast. You know what? I'm so excited to be talking to you today because I kid you not, it's taken me 2 years to actually sit down and record this episode on permanent life insurance because I found the topic so complicated and I was just wanting to find the right person. And I know we've had some conversations leading up to this. I've honestly really enjoyed talking to you. And I felt like you would be just such a wonderful fit to come on the pod and educate us on this topic and also talk about it in a very balanced way. So that's why I wanted you here. So welcome.
Thank you. It's awesome to be here.
Yeah.
Thanks for the opportunity.
Yeah. So Jeff, maybe I could just hear my coffee machine going off in the background. I may need to refuel at some point in this episode. But anyway, so why don't you just tell us a little bit about yourself, your background, kind of what you do to kind of set the tone, and then we can dive into the topic.
Sure. So most importantly, I am a dad to 3 crazy little people, 2 dogs, and a husband to a very incredible, supportive, and successful business owner wife. And I just like to acknowledge that, we're little in our lives without our champions, and Danny is definitely my rock. So, it's helpful also to have a partner who understands your own business because she grew up with her father in the business. So she's seen the highs and lows and knows, the late nights and early starts and all of the, the great things that can come with it also. Career-wise, so I'm a little bit of an anomaly here, but in my past life, I'm a failed employee in tech and government, and I learned I was not very good at following others' rules, but I did make some really meaningful and personally fulfilling contributions in the fields of human rights, advocacy, and policy development, which is cool. And like many others probably in the financial advice field, although I fell into insurance. So I did eventually join my father-in-law's practice, which is now in its 3rd generation of continuity and 3rd generation of ownership. My wife's grandfather, Sam, he was one of the first advisors or agents in Canada to incorporate his own firm. And we've now been at this for 61 years at just staying in our lane and specializing and advising caring families with insurance-based strategies and solutions. And, shockingly, this has really felt like my calling for the last 9 years. I identify with business owners and entrepreneurial professionals because, frankly, I am one. And, I'll just spend a second here shouting out my partner, Peter Seligman, who has recently completed his 41st year in the industry.
Wow.
He's had a, by all accounts, a legendary career, which is not just about sales success. It's really, it's staying in the business and having, having a client base that extends really like now into 4 generations. And he's always put his and our mutual clients first. And I've been, very fortunate to reap those benefits of seeing that advice in action as I've now been managing our practice for the last 5 years and, doing reviews with clients, seeing what they're up to. So it's been a great growth environment, and got the designations, all the table stakes stuff that we can talk about, but people can find.
That's incredible. I honestly, I didn't know that it went back so many generations. That's beautiful, Jeff.
Thanks.
So okay, let's start talking then about permanent life, and maybe you can just tell us very basically, like, what is permanent insurance. And we don't need to talk too much about Term 100 because in episode number 2, one of my guests gave a pretty good overview of Term 100. So just basically, what is permanent insurance before we dive into the details?
Sure. So, permanent insurance is often thought about or marketed in the retail space as lifetime coverage. And you've probably seen some cheesy YouTube videos that insurance companies and some enterprising brokers, whether on TikTok or whatever, put out about how much better it is to have your insurance coverage for life, for your lifetime, than for a period of time after which it will inevitably expire. They often acknowledge the cons, like how permanent insurance is more expensive than term insurance. But while the lifetime coverage aspect may be true, that's not really the hook that I think incorporated professionals like physicians, business owners, and the high net worth should really be focused on. So, really distinctly, the attribute that separates permanent from term insurance is its role in accumulating investments inside of the policy. So although there are prescribed limits to how much one can accumulate, this is boring stuff, but it's known as the MTAR, so the maximum tax actuarial reserve. The limits are very generous for those who can actually qualify. So as a rough estimate, for every dollar in mortality charge, so the portion of your premium that actually covers the cost of insuring your life, one can deposit roughly $3 to $4 of additional money inside that policy, which is going to grow tax sheltered and will be paid out on a mostly tax-free basis when an insurance death benefit is triggered. The relevance, I think, here or function, like we're going to talk about, where it fits, obviously, of permanent insurance, but this is important. And it's a weird comment to make. And I don't want this to sound salesy, but it's harder to evaluate the value of permanent insurance in the context of cost. So this is really ultimately an exercise in optimizing one's deposits into this unique investment vehicle that happens to really sit inside a life insurance contract. There are a lot of ways that one might approach this optimization exercise, but thinking about it as buying insurance in the traditional sense that you buy car insurance, home insurance, other forms of life insurance, health insurance, this is not the way to be thinking about how to make a choice for where you ultimately park your dollars earmarked to this vehicle.
Okay. So you talked about some important terms there, like tax sheltered growth and death benefits. We're going to dive into exactly how to use these policies a little bit later in the episode, but just big picture, like what would be the main role? Like what would be the main reason why someone would want to open it? Is it thinking about the next generation, or is that the number one reason, or is there more to it?
Yeah, it's manyfold, I guess. The way I would put this to your listener base is that permanent insurance is rarely about a need, and it is almost always a discretionary choice. So we're going to talk about this, but just because it's discretionary doesn't mean that it's not potentially in many situations the most logical, cost-effective, or tax-efficient way of funding an obligation that is not terminating. So, it's a forever sort of obligation, but it's easier in some ways to kind of contrast this with, term insurance or need-based insurance. So to put this in perspective for your listeners, what I mean by need versus choice is that, if I'm coaching, let's say, a younger physician in a similar stage of life as me, so, they may have young dependents, significant, lifestyle and carrying costs. They may or may not be over leveraged, very high income replacement needs. Should my human capital stop being counted on for contributions to the household? I think it's safe to say, and this is the only rational sort of approach to it, is that these are needs that will eventually terminate or at least decline over time. Please God, I hope they do. Now, I might choose and I might want to guarantee some of these particular outcomes with permanent financial capital that's contributed by life insurance. So whether it happens at my age 38 or when I'm 90, that's a choice that I am absolutely free to make. But when it comes to like the natural sort of application, so it's kind of as you said. So it's either thinking about dependence in that way. So I'll give you an example here. So if someone was financially responsible for a family member with a disability, this is very specific, but I personally am. My brother lives with us, and that will be my financial obligation for my lifetime. So that could be an area of opportunity for permanent life insurance to play a role. It could also make sense where there are blended families. So second spouse or partner, kids from a first marriage. Harmony logistics call for that sort of matriarch patriarch to decouple their income or capital between the kids of the first marriage and that second spouse. The other place where it really makes a great deal of sense is where there are like very quantified liabilities that need to be addressed someday. So you may have heard the term estate freeze that might have come up in previous conversations on the pod. So where taxes on the growth of business, real estate, or investment vehicles is shifted to a subsequent generation, permanent insurance can be a really great method for funding those obligations rather than alternatives. So instead of raising cash from selling assets, taking loans that may be expensive or called on, sinking funds where you're saving, or similarly. Plus, you get the benefit then of taking advantage of, theoretically younger ages. So in sum, where there is clarity in desired financial outcomes or in being able to achieve very specific and measurable outcomes, permanent insurance is often, a logical step when you're thinking about it from, why would I buy permanent insurance? As opposed to the sort of accumulation, alternative asset investment type class that it is that we're going to spend probably the majority of our time talking about today.
Okay, so maybe let's talk about a few basic insurance concepts. I know there's something called the adjusted cost base, and then there's also that capital dividend account, the notional account inside our corporations, which helps to make these policies, when used appropriately, tax efficient. Maybe you could just tell us, I know we could talk a lot about these concepts, but just the basics, like what do we need to know about the adjusted cost base? And then what do we need to know about the CDA account in terms of moving the money tax efficiently to the next generation? Like, how does that work?
For sure. So, to start, this is a pod about life insurance, so I'm not going to pretend like we're, discussing riveting material. This stuff is extra boring, but it's fundamental to understand. So the first thing, and this isn't to be a stickler or to be a pain in your butt. Am I allowed to swear here? I can swear, right?
You absolutely are. Like, absolutely are.
I don't know if ass is a swear word, but I'm going to be a pain in the ass. So first of all, for your listeners' reference, almost all of your discussions in other prior conversations deal with adjusted cost base, like you said, which is typically the cost of acquiring a property plus any expenses that you may have made to improve it, right? So insurance, because we always like to be different and complicated. So insurance taxation, they refer to this as an adjusted cost basis. This is different than adjusted cost base. And this is mainly determined by the cumulative premiums paid, so what you have actually deposited into the policy, less the cumulative net cost of pure insurance, so what it actually costs to insure your life, less any potential policy loans that one might have taken from their policy, plus any of those repayments. So this is, it's a function, it's important because it's a metric that actually determines the after-tax values of insurance payments for corporate-owned life insurance, or, and we're going to talk about this, the part that sucks, or taxable income when taking policy loans or surrendering a policy for its cash value. Yeah.
And then let's say you own one of these policies through the corporation. How does it kind of funnel to the next generation upon death, whether it's first to die or second to die, through the capital dividend account? Just a quick summary on that.
Sure. So as your astute listeners will know from your earlier conversation with Looney Doctor, Dr. Mark Soth, capital dividend account, CDA, is a notional account of a Canadian-controlled private corporation. Its values aren't going to show up on your Medicine Professional Corporation's financial statements, but it is tracked by your accountants, made up of the non-taxable portion of capital gains, net of capital losses, and capital dividends received from other companies and life insurance proceeds net of their ACB, which we just talked about. So where a corporation is the owner and beneficiary of a life insurance policy, and I'm going to use an example with round numbers and makes it easy for us here. So let's say owner has $2 million life insurance policy. On the death of the insured life, maybe it's the owner, maybe it's someone else, but we'll keep it the owner for simplicity. The insurance company would pay that corporation $2 million. Mm-hmm. However, that's the death benefit. However, the money needs to make its way out of the corporation. So the way that it's dispersed is through the CDA to the beneficial corporate shareholders. CDA, life insurance can be a very unique instrument, and the majority of that has to do with its taxation. So CDA is really the secret sauce of corporate-owned life insurance, and it's the mechanism that allows the majority of insurance death benefit proceeds to be paid out tax-free to the corporation's surviving shareholders. From just earlier on the ACB, we noted that figure determines how much by way of the insurance proceeds are going to be paid out tax-free to the corporate beneficiary. So using the $2 million example, and if there's an ACB on the insured's death of $100,000, so, I die at 89, and there's still some ACB balance there. It's $100,000. $1.9 million can be distributed out of the capital dividend account tax-free to the corporate shareholders, my wife, whatever, presumed in the case of, a closely held business or professional corporation to be the partner or the children of the owner. And I just wanted to say, sort of as a side note here, for it's rare for single owner professional corporations to be governed by shareholders or partnership agreements, but it's vital, for listeners as, either clients or, if they have advisors in the mix, to tell them, your tax, legal, and insurance advisors must ask about and review any existing or planned agreements to ensure that the verbiage around how insurance policies and receipt of benefits are received is consistent with the wishes of the owner. This is just, it sounds basic, but you want to make sure that things work the way that they're supposed to. So to the extent that there is any positive ACB balance on that insured's death, like our $100,000 example here, this amount would be distributed to the shareholders as a taxable dividend, subject to provincial tax rates, as any other dividend would be treated. And, it bears just mentioning that although it's rare, because, usually the money is needed for estate matters, but, the insurance proceeds can be left inside the corporation to be sat there and distributed later on via the CDA. It's not like insurance comes in and it has to exit the corporation immediately. But, while received tax-free, obviously any growth or gains on the capital, either dormant in a savings account or invested, whatever, it's going to be subject to passive income tax rules. So, just mentioning kind of how people might use this.
I'd like to take a minute to talk about a company that I've been following for a few years now. I initially met them on this very podcast and was taken by their story and passion to make life better for doctors. Introducing Aria Health, the groundbreaking electronic health records company that's redefining the way doctors practice medicine. Aria Health is all about putting doctors back in the driver's seat, in control of your destiny to become the doctor you've always aspired to be. Aria Health is not your typical EHR company. They're all about keeping the focus where it belongs, on you and your patients. They want to empower you to be caring, present, efficient, and powerful in your medical practice, without the burden of endless note-taking and paperwork. Join the Aria Health community of doctors who are already taking back their lives and practicing medicine the way they were meant to, free of corporate shackles, one patient at a time. But that's not all. Your time is precious and you want to get back to what truly matters. Aria's unique promise is to get you up and running as a new clinic in less than 30 days. And if you're thinking about integrations or migrations, don't worry. Aria can get you set up in less than 2 months so you can seamlessly transition without missing a beat. What sets Aria Health apart is their unwavering commitment to helping doctors thrive and making doctors the heroes of the healthcare story. They leverage the power of artificial intelligence, handling complex data ingestion and automating workflows so you can focus on patient care, not paperwork. And I've seen this in action myself. Visit ariaehr.com. That's ARYAEHR.com, and discover how ARIA can empower you to take charge of your medical practice. You can use a special code BeyondMD to get your first month for free. Perfect. So maybe to wrap up part one, I know I sent you a lot of questions, right? So now it's my turn to be a bit of a pain in the ass. I know I'm pretty detail oriented, and I'm just trying to get to the bottom of it. But maybe we can just go over a few key definitions. So in the permanent life insurance bubble, there we have universal life insurance. We've got, I guess, non-participating whole life insurance, and then we've got participating whole life insurance. A quick summary of these, summary of definitions and key distinctions might be useful before we pick away at these topics in more detail.
Sure. So, universal life insurance, I'll just say UL, is considered kind of like a pure form of insurance in the sense that, the three typical components of a policy are unbundled and very transparently tracked. Like you can see all of these items. So generally speaking, that's mortality charges, there's administrative expenses, and then there's the investment component. So UL can sometimes allow for a little more creativity in customizing an insurance program to someone's specific risk reward preferences. Sometimes that can, involve reducing the specific cost of insurance, selecting, their particular investment allocation. And these kinds of plans, they often fit in with the DIY investor's philosophy and approach. The caveat I would make there is that, whereas a bad investment selection in a traditional non-registered account may lead to a loss, and, that can be really painful, having the same outcome in your insurance plan can be more significant because that can actually lead to the collapse of the policy or the requirement to inject, substantially more capital than was intended. So this is why, with all other investments, your listener base are savvy and smart, but asset allocation and investment strategy becomes essential. And so when people might be considering a permanent life insurance component to their portfolio, they start to understand the factors and variables. Many times they just decide actually that they don't want to self-manage this component of their family's long-term legacy capital because it's so dependent on, that policy owner's actions that this isn't really a set it and forget it sort of plan to the extent that any, insurance policy is, but it really does require a lot of careful oversight.
So that's a UL. What about, I guess, participating whole life insurance, which we're going to talk about in a lot of detail, and then also alongside it, non-participating whole life insurance. Just a quick summary of these as well before we go on.
So I'll start with non-par. So non-par whole life provides a lifetime guaranteed amount of life insurance. It also has guaranteed cash values that increase until it equals the insurance amount at age 100. Non-par and par, which we'll talk about in a second, they share a common foundation of guaranteed premiums, guaranteed cash values, and guaranteed death benefits. That's what you need to know.
Let's move on to part two then. So the components of these policies. So we talked about the death benefit. We talked about the cash value or the CSV, the cash surrender value. Just tell us a bit about these components, kind of how they grow over time. My understanding is that the cash value will never obviously exceed the death benefit, but they will both increase, I guess, at a certain rate. But then you mentioned that word guarantee. Are both of these guaranteed in both participating and non-participating policies? Just talk to us about these components and how they kind of change over time and what we need to know.
Sure.
I know it's a big question, but
do you want to save the sort of reference point definition for par participating for later on?
We can go over it now if you think it's going to help understand.
Well, I just thought I wasn't sure if in the flow, but it's
yeah. Let's do that then.
Sure.
Let's do that.
Sorry if this is an edited.
No. Yeah, this is important.
Edited segment. Okay, so for I got the majority of these comments, like in our pod here, is gonna talk about par, but it's really so. There's a few things because there's a lot of confusion in the market around par for sure. So it's important when I'm talking about in this context participating whole life insurance. I am really focused on par with paid up additions or the sort of that dividend version of par which, PUA, whatever, paid up additions. Most companies have different dividend options to choose from. PUAs are the most common. And, for your listener base, I think colloquially, you can define this as like a dividend reinvestment plan, like a DRIP, right? So one of the primary differences here between par and non-par, and you asked about this, is that the participating policyholders share in that risk with their insurance company. So this means that benefits are shared when performance is better than expected, which will come in the form of dividends. But conversely, and although it can't be negative, par policyholders may be penalized from that poor performance, which would just result in sort of no dividend paid. Your policy can never be in a negative position. But where it's really interesting actually is that par whole life can be neatly compared with non-par by unbundling the guarantees in non-par, unbundling the guarantees from those non-guaranteed values. So there are three basic pieces to the product. It starts with the guaranteed base, which, as we talked about with non-par, you can just purchase that full stop on a standalone basis and you're done. No growth, guarantees only. The next piece, and we'll spend a lot of time talking about this, but par is really an investment in the participating fund of the insurance company. The third piece, which, some people want to go full tilt, I would kind of refer to this as like the cleanest access to the par fund. This is when, you might be stuffing in those extra, that $3, $2, $4, whatever it is per dollar of base par that you have, more money into the policy. So although, and this is going to be important for your listeners, although there are expense loads on these additional deposits, which, they may cover costs like, our commissions, premium tax that the insurance company pays the government, investment income tax that they hold back, firm fees, for their managers who are investing in the funds, and administrative expenses. These are typically much lower than the fees on just the base par. Ultimately, like a great way of thinking about this is that, participating policyholders, you're not just purchasing a policy. You're not just purchasing an insurance and investment vehicle. You're actually purchasing almost shares in like a mini insurance company via the par fund. That was that. And now happy to talk about all the components, if that's good.
Yeah. So I think the one component of these policies that we place a lot of emphasis on, the death benefit, and I think that's fairly self-explanatory. But then there's also the cash value. And so I imagine ideally that both of these components will increase with time. I guess the growth of the cash value at least can vary, especially for the par fund, depending on how it's performing. But can you just give us a quick summary of how we can generally expect these components to increase over time? I just want to make sure we understand the components before we dive into the details.
Sure.
Yeah.
Okay. So, just from a high level standpoint, like there's not a lot of complexity, as you said, to death benefit. This is the life insurance payout on death. Personally owned policies, that amount is always going to be tax-free. We talked about with CDA. So, reviewing that, it's going to be a little more instructive to look at CDA and ACB figures, but that's, ultimately pretty close to the actual death benefit number. Cash surrender value. So when we talk about that in the context of the life insurance policy, from a tax standpoint, that's really considered the amount that's available to the owner of that policy if it is surrendered. Permanent policies, most of them have a cash surrender value. Term insurance policies have a nil value. How these two interact with each other. So we're going to talk a little bit more about that when we get deeper into the mechanics. But in general, growth is a function of a few different methods. So it's either going to be a function of guarantees, which will be spelled out in each contract that one purchases, whether it's non-par, par, investment performance, which is the biggest factor that is generally not known in exact clarity, and we'll talk about smoothing and all sorts of things of how this happens, or of dividends being credited to a policy, which is a function of many things, including investment performance. So for all whole life plans specifically, cash value and death benefit, as you said, they're going to grow separately, but they are linked, and they will have a natural crossover where cash value equals death benefit at age 100.
I know some people who put in small amounts monthly into these permanent life insurance policies. I know other people who swear by them, and they put in excess of $200,000 a year, of course, based on their needs. Is there any benefit if you're enrolled in these policies to put in heavier sums earlier in time rather than later on? Like, will that impact the policy in any way? It's something that's come up and I'm unclear on.
Yeah, this is a really good question. Generally speaking, quick funding a policy, with deposits that might be over contributed, or you're looking at compressing into a shorter schedule. Sometimes you see these from 5 years to 20 years. Sometimes these are guaranteed pay periods. Sometimes they are sort of designed to mimic, a specific guarantee. It's important to know that these ways of doing this prioritizes convenience more than performance. So as a general rule, most policies tend to perform better the longer that they are receiving organic deposits. Your money in, whether that's, again, $1, not $1, but $1 or $1,000 or $100,000, new money is better for these policies, as opposed to redirecting some of the fuel, so that would be cash values, from its own engine to support ongoing growth. Policy performance ultimately is going to be linked very, very importantly to specially individualized factors. The obvious ones that most people think about, are your age, your gender, your health rating, whether you're a smoker. But then there's a lot of other less obvious factors that are going to be more determinant based on that individual's sort of behavior. So the type of product that they actually purchased, like how it was designed, the features of that product, the pay period of their premium. So we just talked about this. These are all important. So I think this will be an interesting sort of anecdote, but I'm involved in a few advisor study groups, master groups, whatever you want to talk about them. And we've modeled out, different planned funding horizons, which take, individuals' ages over to life expectancy plus and minus 10 years. This is usually like the sweet spot, although 20 years is a huge window of variability. That's a great space to be looking at a policy's IRR. More terminology, I apologize, but
It's okay.
I've heard it, internal rate of return. So generally the relationship between one's cumulative out-of-pocket deposits and the benefits that are illustrated in a given year. So just to answer your question here, although it isn't based on an exhaustive sample size, we've observed an almost identical IRR at life expectancy, so maybe 85, between a life pay and a 20 pay structure. But IRRs are improved at life expectancy less 10 years. So, you have a bad sort of run in a life pay chassis. So somewhere where someone is paying, maybe smaller deposits over a longer period of time. And the opposite holds for 10 years past life expectancy, when shorter pay products are involved. So, maybe it's 20 years that you're putting the money in. There are these are questions that come up, I know, but as you know, there are so many inputs that should or, must go into designing the appropriate solution for someone that go well beyond convenience or performance. But, it's that type of deposit flexibility that sometimes, even if it's not contractually guaranteed, this can be somewhat mimicked and guaranteed with good design. So you can kind of have the best of both worlds in a way.
Okay. Talking about policy design, I haven't directly read about this, but I've heard about this through a few people in conversations, and these people are in the same space, but they've told me that you can, in a way, structure the policy such that maybe there's a bit more emphasis on estate planning versus maybe a bit more emphasis on growth. What can you tell us about this? Because to me, this sounds important, and I just like to extract whatever information is relevant here.
Yeah, for sure. So at least when we're talking about PAR, participating whole life, most companies have two basic versions. They have an early growth format that tends to prioritize high short-term liquidity. So with cash values that may start to exceed, your total contributions in around the 5-year mark of the policy, as opposed to a construction that has lower cash values for maybe the first 15 years of the policy, but provides greater growth the longer that the money stays inside, where an emphasis is really placed heavily on as you said, estate values. So insurance values at life expectancy. Some companies have even been introducing hybrid versions of these products, which try to balance out both objectives. I think, importantly for anyone to understand is that there are opportunity costs with every decision in life, as we know, but there are opportunity costs to prioritizing one specific design over another. And most situations where it calls for a permanent insurance solution, there are going to be very specific business facts or case facts that suggest a particular option that might be preferred. As an example, if someone goes into this, and we're going to talk about borrowing and leveraging and all of these things, but if borrowing or leveraged behavior is anticipated early, or it's important that these markers are put in place to accommodate such requests, it's important for a company's balance sheet to reflect a growing asset of cash value life insurance, then accumulation-focused products are probably a better fit for someone. On the other hand, if someone is in this for truly a long commitment, and they very adamantly have no intent of using cash values, maybe in their lifetime, or certainly not unless there was a very significant emergency that, they had sufficient savings to accommodate for, then probably estate-focused designs are going to be a better approach.
Last question in this segment before we move on. I don't have a permanent policy. I have a term policy, but can all term policies be converted to permanent policies, or is that a specific rider inside the term policy? This is something I'm interested in learning a bit more about.
How much time do you have for me on this?
Honestly, the question was going to be a simple one. Can term be converted to permanent life? It was meant to be a quick and dirty one, but
yes. Yeah. Can I give color?
Please do.
You can because I think this is actually this is one of the most important points to reinforce with your audience, because again, I know the discussions about permanent insurance. I know you've had other segments, other podcasts that have talked about term insurance, but I think that this is really when it comes to duty, this is what I need to share, and I've got a great soapbox right now. So
okay,
you can edit or cut whatever you want, but term insurance from almost every Canadian insurance company is an excellent product. Most, but not all, term insurance is renewable and convertible. This is contractually guaranteed. It will be spelled out in very specific language. However, this doesn't mean what many advisors lazily preach to their clients, which is that all term products are the same. This is a commodity, and that you can convert to whatever you wish later in life. This is not true. You have to read the contract. To be honest, most insurance advisors don't read their contracts that they're selling. Some contracts are more permissive about conversions than others. Certain companies restrict options that one can convert into. We also don't have a crystal ball about what products, what tax regimes, what innovations are going to be available 20 years down the road. So some of this is logical. It's to do a little bit of risk mitigation. And then, more so, certain companies as a market practice, but not contractual, will allow many special conversion requests from their lead advisors. We often ask for, special permission to convert whatever, single life policies into joint life policies, various things. But the truth is that we are not in the business of making prognostications, insurance advisor. We are in the business of risk management. And the way I understand it, risk management is a mandate to provide a client with as many good options for their future self as possible. So this is a little bit more soapbox, but cut whatever you need, I promise. So I am laser focused on advising clients to think about their approach to life insurance planning, not just as a single product. Forget about permanent insurance. I'm just talking about general sort of approach. So, the most sold policy in the marketplace is a 20-year term policy. But, instead of just doing a thing, buying a product, consider instead building a diversified portfolio of coverage like you would, with all of your other investment decisions, that can give, the family or the individual, maybe addressing a need, but the right amounts of coverage at specific stages of life. More importantly than that, though, it's a portfolio that you should approach with, staggered terms. So, 10-year, 15 or 20 or whatever. Have a couple companies in there and set it up so that in the future, you can reduce or drop coverage when it's desired or as each term, hits its maturity or renewal. If someone's healthy, they can replace that maturing policy with something new. Maybe it's temporary, maybe it's permanent, or to your initial question, you can convert any amount of the term policies non-medically and contractually to a lifetime product offered by that company at that time. So, if we view life insurance planning in general, but term specifically in this way, it provides forced windows of opportunities and options, at specific times, like 5 years, 10 years. You buy the 20-year policy, you put it in your drawer, you don't look at it for 20 years. That's not a great future state to end up in. But you can actually think and plan strategically about what your future self wants, needs, and is able to do. Whether that's permanent insurance or not, it doesn't really matter. But term insurance has never been more affordable. It guarantees your insurability no matter what, and it gives you planning options for the rest of your life. Rant over.
Jeff, I can sense the passion. I love it. Thank you for the color and candidness. And I talked to my advisor about this before, and the convertibility of term to permanent had come up and was emphasized as being something potentially important. So hopefully I'm all good there, but you've encouraged me to pull out my policy. Maybe I'll read it on my flight. It might be a good way to fall asleep, but anyways, I'm going to try.
You'll have a great sleep then.
Yeah. Guys, thank you for joining us on Beyond MD, and I hope that you will continue to join us on the subsequent episodes covering permanent life insurance, because I kid you not that there's information here that just blew me away, and Jeff does a phenomenal job explaining it all. So, social media links in the show notes along with Jeff's email. I encourage everyone to stay curious and keep learning. We will see you soon.